$200 per ounce. That was the bid placed by a procurement officer at a major American solar panel manufacturer on the morning of December 29, 2025. The official spot price on trading screens showed silver at roughly $80. The officer was offering more than double that price for immediate physical delivery. The bid was rejected, not because the price was too low, not because there was a better offer on the table. The bid was rejected because no one was willing to sell at any price. When a buyer offers to pay 250% above the listed market price and cannot find a single seller, something fundamental has broken. The question is not whether silver is expensive or cheap. The question is whether the price on your screen still represents reality. To understand what unfolded on the morning of December 29th, one must first understand the architecture of the global silver market, specifically the outsized role that London plays in determining prices, settling contracts, and physically moving metal around the world. The London Bullion Market Association, commonly known as the LBMA, operates the largest over-the-counter market for precious metals on the planet. Approximately 70% of global physical silver trading flows through London. The daily London Fix, a benchmark auction that occurs each morning, sets the reference price used by miners in Peru, refiners in Switzerland, and manufacturers in Texas to settle billions of dollars in contracts. London is not merely a trading venue. London is the central nervous system of the global silver market. The vaults beneath the city hold hundreds of millions of ounces, metal that backs exchange-traded funds, secures industrial supply chains, and serves as collateral for derivatives positions held by banks across multiple continents. When London functions normally, the price signals emanating from this market reflect genuine supply and demand. Buyers bid, sellers ask, and the intersection of those intentions produces a number that the world uses as truth. On the morning of December 29th, the first trading day following the Christmas holiday, London did not function normally. The trading screens showed a price. The price barely moved. But behind that static number was something far more troubling than volatility. Silence. The phones at major bullion dealers went unanswered. The LBMA's general inquiry line directed callers to voicemail. Vault operators who typically responded within minutes went dark. Email inquiries to trading desks received no replies. The busiest physical market in the world had, for all practical purposes, stopped communicating. This was not the silence of a slow day. This was the silence of a system that had been instructed to stand down. Markets require liquidity to function. Liquidity is not simply the presence of money. It is the presence of participants willing to transact at quoted prices. When those participants withdraw, when they refuse to answer phones or return messages, the posted price becomes theoretical. It exists on a screen, but it cannot be executed. The distinction between a quoted price and an executable price is the difference between a map and the territory. The map says there is a road, but if the road is washed out, the map is fiction. On December 29th, the silver market in London presented a map that bore no relationship to the territory. Several structural factors help explain why this divergence emerged and why it matters for global capital flows. First, consider the nature of London's vault system. The metal stored in London vaults serves multiple masters simultaneously. A single bar of silver might be recorded as backing an ETF share, pledged as collateral against a derivatives position, and theoretically available for industrial delivery, all at the same time. This works as long as only a small fraction of claimants demand physical possession at any given moment. But when delivery demands surge, when industrial users exhaust their inventories and pension funds begin converting paper claims into physical metal, the fractional nature of the system becomes exposed. There is not enough metal to satisfy all claims simultaneously. The system relies on the statistical certainty that most claims will never be exercised. When that certainty breaks down, vault operators face an impossible choice: deliver metal to one claimant and default on another, or freeze all withdrawals and buy time to sort out the mess. The reports emerging from London on the morning of December 29th suggested the latter option had been chosen. Messages from vault operations personnel indicated that silver withdrawal requests, including requests for allocated metal, meaning bars with specific serial numbers legally owned by specific entities, were being queued pending compliance review. The stated justification was ongoing market disruption, but the practical effect was a freeze on physical movement. This distinction between allocated and unallocated metal deserves careful attention. Unallocated metal is essentially an IOU. The holder has a claim against the bank or vault operator, but does not own specific bars. If the institution becomes insolvent, the unallocated holder becomes an unsecured creditor, standing in line with other claimants in bankruptcy proceedings. Allocated metal, by contrast, represents direct ownership of specific physical bars. These bars are theoretically segregated from the institution's general assets. They belong to the holder the way a painting in a storage facility belongs to its owner, not to the facility. But ownership means nothing if the owner cannot access the property. If the vault refuses to release allocated bars, citing force majeure or regulatory review, the owner's legal rights exist only on paper. The silver sits in the vault, listed as someone's property, but functionally unavailable for any practical purpose. The freeze reported in London effectively removed hundreds of millions of ounces from the available supply, not by confiscating them, but by immobilizing them. The metal exists, it appears in audit reports, but it cannot leave the building. Second, consider the timing of the freeze relative to the New York trading day. London opens hours before New York. In normal conditions, price discovery in London informs the opening prices in American markets. Arbitrageurs ensure that prices across time zones stay roughly aligned. If London rises, New York opens higher. If London falls, New York adjusts accordingly. But if London is frozen, if liquidity has been deliberately withdrawn, then the American Open occurs in an informational vacuum. Traders in New York cannot look to London for guidance because London is not speaking. This creates an opportunity for managed price discovery. Without the anchor of genuine London trading, the American Open can be steered. Algorithms can be programmed to quote prices that bear no relationship to physical availability. The screen can show $80 while industrial buyers bid $200. The separation between paper price and physical price is not new. Premiums have existed in commodity markets for as long as commodity markets have existed. But the magnitude of the separation and the apparent institutional coordination behind it represents something qualitatively different. When a major solar manufacturer offers to pay 250% above spot and receives no offers, the spot price has become a fiction. It is a number published on a screen, but it is not a price at which transactions can occur. Third, consider the downstream effects on industrial supply chains. Modern manufacturing operates on principles of efficiency that minimize inventory holding costs. Factories do not stockpile 6 months of raw materials. They maintain weeks of supply and rely on continuous deliveries to replenish what they consume. This just-in-time model works beautifully when supply chains function smoothly. It becomes catastrophic when supply chains seize. Silver is not a luxury metal. It is an industrial necessity. Every solar panel requires silver paste for conductivity. Every smartphone contains silver in its circuitry. Every hospital relies on medical devices with silver-containing components. Every electric vehicle uses silver in its electrical systems. When silver becomes unavailable, not expensive, but literally unavailable, these industries do not gradually slow down. They stop. Production lines halt. Workers are sent home. Contracts are breached. The procurement officer offering $200 per ounce was not engaged in speculation. He was trying to prevent a factory shutdown that would affect 3,000 jobs and breach utility contracts worth nearly $2 billion. At that moment, the question of silver's fair value was irrelevant. The only question was whether metal existed at any price. The London freeze, by immobilizing the largest pool of tradable silver in the world, had effectively severed the connection between the financial market and the industrial economy. The screen still showed prices. The factory still needed metal, but the two systems had become disconnected. What most observers miss when analyzing events like the London silence is the degree to which modern commodity markets have become extensions of monetary policy rather than genuine price discovery mechanisms. The relationship between major bullion banks and central monetary authorities is far closer than the public generally understands. These banks do not operate as independent capitalist entities in the precious metals space. They function as authorized dealers, market makers, and, in times of stress, policy instruments. When the Federal Reserve needs to manage dollar liquidity, it works through primary dealer banks. When the Treasury needs to issue debt, it works through the same institutions. When precious metals prices threaten to send signals that conflict with official monetary narratives, the same network of institutions is available to manage those prices. This does not require conspiracy in the dramatic sense. It requires only aligned incentives and established channels of communication. The banks benefit from their privileged position. The authorities benefit from price stability. Both parties understand their roles without needing explicit instructions for every scenario. The silence in London on December 29th suggested that such coordination was active. The pattern was too uniform, too disciplined, to represent independent decisions by multiple institutions. When every major vault operator and bullion dealer simultaneously stops answering phones on the first trading day after a holiday, the most parsimonious explanation is that a directive was issued. The likely purpose of such a directive was to prevent a disorderly price adjustment before American markets could be prepared. If London had opened with genuine price discovery, if the $200 bids from industrial buyers had been permitted to set the price, the implications for New York's open would have been severe. American investors would have logged into their brokerage accounts to find silver up 150% overnight. The panic buying would have been immediate and overwhelming. Exchange-traded funds would have faced redemption requests they could not honor. Options markets would have experienced dislocation that could have cascaded into broader financial stress. By freezing London, the authorities bought time. They created a window in which the American Open could be managed, in which algorithms could be programmed, in which the narrative could be shaped. This is not stability. This is the appearance of stability purchased at the cost of genuine price discovery. The underlying imbalance, too many claims on too little metal, remains unresolved. It has simply been hidden behind a curtain of coordinated silence. The Swiss dimension adds another layer of complexity. Switzerland's position in the global silver supply chain is difficult to overstate. The refineries around Zurich, Valcambi, Pamp, Argor Heraeus, process approximately 40% of the world's silver. Raw ore extracted in Mexico, Peru, and Chile travels to Switzerland to be transformed into the refined bars that meet London good delivery standards. Refining is a bottleneck. Extraction can be accelerated by opening new mines or increasing production at existing ones, but this takes years. Refining capacity, by contrast, is concentrated in a small number of facilities, mostly in Switzerland. Control the refineries and you control the flow of finished metal to the world. Reports on December 29th indicated that Swiss authorities had implemented temporary export review protocols for refined silver. The precise mechanism was unclear, whether this constituted an outright embargo or merely enhanced scrutiny that would slow shipments, but the direction was unmistakable. Switzerland is a small country with a sophisticated manufacturing sector. Precision instruments, luxury watches, medical devices, all require silver in various applications. Swiss authorities, observing the freeze in London and the surge in delivery demands globally, appear to have made a calculation: secure domestic supply before fulfilling external obligations. This represents a transition from market disruption to resource nationalism. When countries begin hoarding strategic materials, prioritizing domestic industry over international trade obligations, the assumptions underlying globalized supply chains break down. For decades, manufacturers assumed that materials would flow freely across borders in response to price signals. Pay enough and you could source anything from anywhere. The events of late December 2025 challenged that assumption. Paying enough was no longer sufficient. The metal was either unavailable or being held by governments unwilling to release it. This dynamic has profound implications beyond the silver market. If silver can be nationalized in times of stress, so can copper, lithium, rare earths, and every other critical material upon which modern technology depends. The lesson being broadcast from London and Zurich was that in a supply crisis, contracts and prices matter less than physical possession and national interest. The events of December 29th crystallized a distinction that commodity analysts had discussed for years, but that most investors had never personally confronted: the divergence between paper prices and physical availability. In theory, the spot price of silver reflects the cost of immediate delivery. If the screen shows $80, you should be able to purchase an ounce for $80, plus a small premium for fabrication and delivery. In practice, the spot price reflects transactions in the futures market, where the vast majority of contracts are settled in cash rather than metal. Traders buy and sell claims on silver without ever intending to take possession. The price that emerges from this trading reflects financial sentiment more than physical scarcity. When physical supplies tighten, premiums emerge. Dealers charge more than spot because the actual metal costs more to acquire than the futures price implies. In normal markets, these premiums are measured in small percentages, perhaps 5 or 10% above spot for retail products. But when physical supplies become critically constrained, premiums can explode. The $200 bid from the solar manufacturer represented a premium of 150% or more. At that level, the spot price has become meaningless. It is a number without a transaction behind it. The London freeze accelerated this divergence by removing the largest pool of tradable physical silver from the available supply. The futures market could continue trading, contracts could be bought and sold, prices could be quoted, but the connection between those contracts and actual metal had been severed. This creates a situation in which the official price can remain stable while the real price goes to infinity. Infinity, in this context, means that you cannot buy the asset at any price. Supply does not exist, the question of valuation becomes irrelevant. For investors holding paper claims, shares in ETFs, futures contracts, unallocated accounts, this divergence represents an existential risk. Their holdings are valued based on the spot price, but that price may not reflect what they could actually receive if they attempted to convert their paper into metal. For investors holding physical metal, coins, bars, allocated accounts with reliable counterparties, the divergence represents a windfall. They possess something that industrial buyers need desperately and cannot obtain through normal channels. Their holdings are worth whatever a solar manufacturer or electronics producer is willing to pay. The distribution of winners and losers in this scenario is determined entirely by the form of ownership. Paper versus physical claims versus possession. Maps versus territory. Understanding the London silence requires appreciating how modern markets can be managed without formal halts or public announcements. A trading halt is a visible intervention. It appears on news feeds, it generates headlines. It signals to the world that something has gone wrong. A liquidity withdrawal is invisible. The screens remain active, prices are quoted, but no one is willing to transact. The market appears functional while being fundamentally broken. This distinction matters because it shapes public perception. Investors who see a trading halt understand that abnormal conditions exist. They adjust their expectations. They prepare for volatility when trading resumes. Investors who see a flat chart with stable prices assume normalcy. They do not recognize that the stability is artificial, that beneath the calm surface, industrial buyers are bidding multiples of the quoted price and finding no sellers. The London silence was a liquidity withdrawal disguised as stability. It preserved the appearance of a functioning market while eliminating the substance. This allowed authorities to maintain narrative control during a period when genuine price discovery would have produced chaotic, headline-generating results. The technique is not new. Central banks have long understood that perception management is as important as policy implementation. If the public believes markets are stable, they behave as if markets are stable, which can become self-fulfilling. The challenge arises when the gap between perception and reality grows too large to sustain. On December 29th, that gap had become a chasm. The quoted price bore no relationship to executable transactions. The calm on the screens bore no relationship to the panic on the procurement desks. The narrative of stability bore no relationship to the industrial supply chain that was seizing in real time. In the end, the events of December 29, 2025 were not primarily about silver. They were about the nature of price discovery in modern markets. They were about the tension between financial representations and physical reality. They were about the assumptions embedded in global supply chains and what happens when those assumptions fail. For decades, investors treated screens as truth. The number on the terminal was the price. The price was reality. If you wanted to buy, you paid the price. If you wanted to sell, you received the price. The system worked. But a price requires willing participants on both sides of the transaction. It requires liquidity. It requires a functioning connection between the financial system that quotes prices and the physical system that delivers goods. When that connection is severed, when vault operators stop answering phones, when withdrawal requests are frozen, when refiners prioritize domestic supply over international contracts, the price on the screen becomes an artifact. It reflects what was, not what is. The solar manufacturer bidding $200 understood this. The quoted price was $80. The real price was undefined. No amount of money could purchase what did not exist for sale. This is the hidden fragility of modern markets. They are robust in normal conditions and brittle in stress. They function beautifully when everyone follows the rules and collapse rapidly when participants begin defecting. The silence in London was the sound of defection. It was the sound of institutions choosing self-preservation over market function. It was the sound of a system optimized for efficiency, discovering that efficiency and resilience are not the same thing. Markets will eventually clear. Prices will eventually adjust. The physical world will eventually impose its constraints on the financial abstractions built atop it. The question for investors, for manufacturers, for anyone whose livelihood depends on commodity markets, is not whether this adjustment will occur. The question is whether they will be positioned on the side of the adjustment that benefits from clarity or the side that suffers from the end of illusion. The screens show prices, the phones go unanswered. Somewhere between those two facts lies the truth about what things are actually worth.